Bonsoir tout le monde. Je prends quand même le temps de vous remercier d'être ici en aussi grand nombre. C'est vraiment une belle soirée. On est vraiment très, très contents. Euh, vous êtes tous comme moi, probablement impatients de vous rendre au cocktail. Ceci dit, on a gardé justement un beau plat pour la fin. Mais on vous invite quand même à rester à la fin. Après la dernière portion, on va servir effectivement un cocktail avec des bouchées à l'extérieur. C'est vraiment une belle occasion pour, évidemment, connecter entre vous tous, rencontrer les entrepreneurs, rencontrer les VC qui sont ici ce soir. Fait qu'on vous invite vraiment à prendre le temps de rester puis savourer ce que Nectar a concocté dans sa cuisine. Fait qu'on a on présente ce soir un invité bien spécial. Et pour entretenir la discussion avec notre invité bien spécial, j'invite sur scène mon collègue partenaire chez Amiral Ventures, Fred Bastien. Fred se passe de présentation, mais je prends quand même le temps de vous dire quelques mots sur Fred, qui a passé les 20 dernières années dans l'industrie en mobilité, en datant l'intelligence artificielle. Il a été fondateur CEO de Nubo, il a vendu Nubo à Spentech pour plus de 100 millions de dollars. Il est aviseur, mentor pour de nombreuses organisations, Creative Destruction Lab, NextAI, Vers Croissance Québec. Il est coach pour plusieurs startups. Il est évidemment chairman du conseil d'administration d'Ange Québec. Fred détient un bac en génie électrique et il est bien sûr aujourd'hui mon cofondateur, managing partner pour Amiral Ventures. Fred, je t'invite à te joindre sur scène à moi. Notre invité spécial ce soir, Tom Birch, qui est ici avec nous. Il est vice-président capital de risque et technologie à la Caisse depuis 2015. Il dirige l'ensemble des activités d'investissement de la Caisse en capital de risque et en technologie à travers le monde au sein de l'équipe de placement privé. Tom a plus de 30 ans d'expérience dans l'exploitation de logiciels d'entreprise dans les secteurs des centres d'appel, des télécoms, de la gestion, relations clients, commerce électronique. Avant de se joindre à la Caisse, il était vice-président en développement d'entreprise chez Télésystème, dans la grande famille Télésystème, et associé principal pour Propulsion Ventures. Tom détient un bac en maths, un baccalauréat en informatique de l'Université Queen's, et ainsi qu'une maîtrise en administration des affaires de Western en Ontario. Ceci dit, ce soir, on l'accueille en tant qu'ami. Il y a plusieurs personnes dans la salle qui le connaissent très, très bien, qui ont délai avec lui dans le passé. On l'accueille en tant que monument aussi, si on veut, de l'industrie du capital de risque au Québec. Tom fait partie des meubles, on peut le dire comme ça. Il est chez lui à l'espace CDPQ, évidemment. Alors, je vous invite à l'applaudir chaleureusement sur ça. Puis Fred, je te laisse continuer avec le thème.
Thanks, Tom. Merci tout le monde d'être là. Merci, Tom. As I guess as Tom said, I think you're an OG, and that's what my daughter would say, of the ecosystem. And I think you maybe weren't there when the Réseau Capital guys have presented their numbers early on, but they gave a little bit of history of the 90s and the Rapport Brunet, and like you're one of those that have seen this ecosystem. You spent like 20 years as an entrepreneur, then 20 years in capital or 18 years in capital with La Caisse, but before that with Télésystème in the early 2000s. So we're kind of very eager to get your perspective on the early stage venture cap and the early stage ecosystem today when you look at it from the angle of you've been an entrepreneur, you've been a venture capitalist, you are an LP in some sense as well. So what do you see? What's happening in your stance in the market right now?
So one of the reasons I'm here is that when I negotiate with an entrepreneur or I negotiate with a VC fund or I negotiate internally at a CDPQ to get more capital to invest in VC funds and deals, is that I've been around all sides of the table. So I consumed angel capital, venture capital for my 3 startups. I joined a small venture capital firm called Propulsion Ventures, which was within Telesystem. And that was in 2006 era. Then the whole world fell apart in 2008, 2009. And I was going to go run another software company in Canada. And Christian Dubé from the Case Poe asked me to try to give something back to Quebec. And so I said, success breeds more success. So we need to have bigger successes. And the only way to get bigger successes is to have more seed funding to build the size of the farm team so we can cherry pick the best deals. But if you have early stage deals, you still need to have Series A, Series B funds. And then in Quebec and in Canada, for that matter, there's really no Series C or Series D opportunities. So what we're trying to do is help Quebec and Montreal and Canada have successes, because successes breed more successes. In terms of the early stage panel here earlier, I noticed that a lot of new seed funds have been established, which is great. But when the LPs invest in a seed fund, they need to commit for the follow-on fund, because within the first 4 or 5 years, you won't have any returns, because a seed fund takes 13 years to have decent returns. So you need to commit, let's say, 20 million into a seed fund, and then invest in Quebec, and others need to be 20 million in the next fund 5 years from now. So you need to have a 10-year commitment. Otherwise, we're going to have these seed funds, and there's no distributions, and no IRRs, so they will never get re-upped for the next round. So we got to fix that problem.
So it's a long-term game, right?
Yeah. And then with CDPQ, I said, well, we need to put in 500 million a year for the next 20 years, because you can't really time the market, because everyone in Quebec got into VC in 1997. They all got it in 2001. They sort of got it in 2006, and they sort of got it in 2009. And it's happening again. So all the other Canadian pension funds, like OMERS and Teachers and CPPIB, BCI, they sort of got in, and now they sort of put it on pause because they don't have enough distribution, so they can't re-up in the existing funds. But you need to be consistent year in, year out, and build a massive portfolio.
So basically, we're thinking investors should buy low and sell high, but they should keep buying, right? Over a long
Oh yeah, it's like dollar cost average, right?
Yeah.
And it's not really pray and spray. It's sort of early stage VCs is number one is the management team. Number two is the size of the market. Number three is the growth of the market. Number four is the product or service in the market. And the last thing is technology. We never look at technology. That's the last thing we look at if we have confidence in the founder. Someone mentioned that there was an American that came up here and almost doing a term sheet on the way home. So you never know when you sort of hit gold, because if the person understands the marketplace, and then they can give leverage, and they like the founders, that's when they're going to double down right away. So you have to do a lot of pre-marketing when you're running your own little software company. And the best advice I give to anyone doing a seed or Series A round is that go out to the VCs in the Valley, in New York and Boston, and say, I'm going to be raising a round in 6 months, but I thought I'd drop by and say hi. And you drop by with the pitch deck, and these are my forecasts. Just make sure you hit the forecast when 6 months from now, when you go back in, that they're a believer, right? But you can't really go into a meeting and expect to close, because they don't know who you are. They want to see you a couple of times. And that's when the analysts follow up and check you out, right?
Yeah. You're talking about distributions, as obviously LPs wait for distributions, and when you look at the exit market, it's been quite difficult. Like recently, not a lot of exits, definitely not a lot of billion-dollar exits here in Canada. So how do you view that influences VC fund construction, VC fund sizes, right? It's harder to return 3x on a half a billion-dollar fund than it is on a $50 million fund. So does that influence what's being created in the market? Should it?
Well, every pension fund should be investing as many VC funds right now, so you can deploy as much capital right now, because the market's starving for capital. And there's some really good deals to be had in companies that were overvalued. Let's say they were valued at 500 million and they were only doing 10 million in revenue. Now those companies are doing maybe 30 million in revenue, and they should be valued at maybe 250 to 300 million. It's a great time to double down and make some really good investments in a company that's proven itself, especially over the last 24 months. So if people are saying, well, we don't have enough distributions to reinvest in other funds, they're missing the opportunity. Because in 2009, all those 2009 vintage funds just made a killing. So the LP should be investing in the funds right now to invest in companies like Maxa, for example.
Yeah. And what's the role of the founder in this, right? Because founders, well, we hear a lot that founders sell too early in Canada, at least in smaller. So how do you agree first? And if founders are part of the equation for VCs to return distribution, well, should they get more involved in secondary options for VCs and things like that?
So there's always history, right? So back in the early 2000s, I sold my software company because I had to create a return for my VC fund so they can go raise another fund. And I sold the company for $31 million and everyone was happy. But that company today could be doing $1 billion in revenue and still growing at 20% year over year. But we had to create DPI for the VCs. So now the VCs learn to hang on a little bit longer because the size of the funds are bigger. But from an entrepreneur's perspective, you sort of have to always figure out what your plan is. So whenever I make a direct investment, and it's very simple. I said, what's your website going to look like in 5 years? They said, what do you mean? So tell me what you're going to be in 5 years. And that's what you're going to grow up to be in 5 years. And then what do you want from a personal goal? Like, what do you want? Do you want to build a company that's doing 100 million in revenue or $1 billion in revenue? Do you want to put 10 million in your pocket or do you want to put 100 million in your pocket? You really need to decide what you want. So once you have alignment in terms of yourself and your co-founders, then you can sit down with the VC. So, okay, now we can create a liquidity event for you. We're prepared to sell it for 150. And then you'll work with the VC. But it's like, nope, it's time for us to double down. We're going to go raise a Series C. Maybe we'll do a small secondary of $5 million to keep the rest of the capital in the company to grow. So it's sort of a partnership with the VC and the founders.
And Nikkei has been quite involved in those deals where basically there was an option to exit, but there was also an option to double down and bring it to another level, right? So you're not afraid of secondaries in that sense.
No, so in terms of the VC model within CDPQ, with Chris and Zubay, I said we need to invest in the top 8 VC funds in Canada that might do deals in Quebec. So in the case of Lightspeed, Axel did the Series A, Novia did the Series B, and we did the Series C. But we were able to track that company for 24 months prior to actually investing because we saw the results coming out of the Novia's fund. So we sat down with Dax and we structured a deal. We did the same thing with Fred at Hopper. We did the same thing with Plusgrade. We did the same thing with Nuvei. We knew about the deals and we created some big successes because we were able to track and build confidence with the founders and the results so we can actually double down.
Let's switch gear a little bit to the entrepreneurs, right? And especially the pre-seed, seed, early stage entrepreneurs. We're seeing more and more of them. Well, it's hard to fundraise. Like this is 2023, 2024. Many are bootstrapping longer. They're actually exercising new muscles. They didn't know how to be cash flow efficient and all of that. Sometimes it's positive. Sometimes it's by necessity. But then we also hear VCs saying, well, we don't like startups that are too dependent on shred and too dependent on grants. So how do you, maybe what's your advice on founders that can bootstrap? Should they bootstrap longer? How do you see that?
Well, it all depends what you want, right? Because I saw this one software company is doing about $1 million a year, and he says he wants to get the company to 100 million in revenue. And that's great, but it's going to take 3 rounds of funding. He said, what do you mean? I said, well, the first round is going to probably cost you 25% dilution, the second round, 20%, third round, maybe 15 to 20%. And normally along the way, you screw up. So you probably have to take a 4th round. So at the end of the day, you're left with 10% of the company. If you sell for 100 million, make 10 million, or you can bootstrap your company and keep running it and maybe have a $1 million a year dividend. So it all depends what you want. So founders really got to decide what you want in life and what your end game is, because you could be a regional software VAR and be really successful and you're the master of your own domain and you own 100% of the company. Or you can get a round of funding, then which is another round of funding, then you get 2 VCs around the table and they start to argue and drive you crazy. Then you get 3 VCs around the table, then you no longer control. And because the American VCs want to maximize their shareholder value, they don't really care about you because they want to maximize their shareholder value. So, the friend foe, And if you get 2 or 3 VCs around the table, only take 10% of their advice, because a lot of these VCs have never run a company before. They have lots of theory, but they've never run a company. So just take a little bit of their advice and think about it, and then develop your own plan.
And what do you think about the US-Canada debate? Like we've heard today, like some different ways of working. We talked about speed. We talked about risk-taking and ambition. Did you feel this is the, or
Oh,
maybe do you
yes.
feel this is not the right question to ask?
No, it's so in 2004, I was raising money for my third software company, and I was down in Menlo Park. I got 5 term sheets. I sat down with 65 VCs. And the 60 that turned me down, more or less turned me down in the first 20 minutes. You can sort of see their eyes glossing over. And I said, why? They said, well, you Canadians are really good at technology, but you really suck at sales and marketing. So are you prepared to move to the Valley? If you move to the Valley, we'll fund you. And you don't hear that question as much because deals got so expensive in the Valley from 2019 to 2021, let's say. So they started looking elsewhere, like Chicago or maybe Montreal. So they now are thinking a little bit more globally. But the VC model in the Valley, everyone's paid for taking risks. So normally when you do a deal, there's always 2 rounds, and Series A, maybe Series B. But if you don't deliver this Series B, they walk away and they move on. They don't give a shit about you. And then so you're sort of stuck. Whereas in Canada, in Quebec specifically, sometimes we have a 3rd round and a 4th round, whereas the company should be shut down. And we tend to be too nice. So we end up keeping some of these companies around for eternity, whereas they should be shut down.
It's hard to shut down, but after 3 rounds and lots of institutional money in it, right? It's easier to shut down after a year or 2, or
No, you can shut down for 4 or 5 years. You get, so in a VC portfolio of 20 companies, you have like the top 15% that return the funds, the bottom 15 to 20% get zeros, and the other ones are living deads. And when you have a living dead in Montreal, it's kind of hard to sell it to Cisco, because Cisco doesn't really have much of a presence. But if you have a living dead in the Valley and you got a company doing 6 or 7 million in revenue and you got maybe 100 employees, 60 engineers, Cisco says, I'll buy that company off you for 20 million and take the engineering team and maybe some of the software. So the ecosystem of living deads don't last very long in the Valley, whereas in Canada, they last too long.
and it's partly what you just explained, partly culture, I guess, where we don't want to say no and we want to please everyone. It's partly maybe too generous
Well, in Quebec, we're too
ecosystem.
kind.
Yeah,
We're
exactly.
relationship-oriented people, right?
So we have a lot of zombie startups in or living dead startups in the ecosystem. Too much, right?
So that's why myself, want to go become the garbage man and clean up these opportunities in our next career.
That's
that
not a
is.
great representation. Let's look a bit more macro, because so it's interesting because there were words of recession. We're not really in a recession, but at least economically, it was a bit difficult in the last couple of years, and there's speculation on the economy keep picking back up in 2025. For most of the people in the room, this is the first cycle, like down cycle of their professional career. You've witnessed the 2008 that led to some fantastic startups in 2009, 10. So
Yeah.
what's your word there? Should we be hopeful about what's coming? And do you feel this time around we'll see again like the best companies and the best tech startups?
Well,
being
they
started?
always say that the best companies are built in tough recessionary times, because you have to worry about the cash and you have to figure out the business model and you have to be frugal in terms of your expenses. But I remember from 1993 when I was running my own software companies, and then 2001, Desert Storm from 2001 to 2005 was really quite painful. And then the same thing happened in 2009. And this is one story which I've shared with probably everyone in this room at one point in time. In January 2009, we did a convertible debenture or convertible note for the Americans in the room with a 5X liquidation preference on the convertible note, because there was no one else around the table. And you go, well, if I put 5X, well, that might attract money from this other person. So all those games are starting to be playing right now. So in the Valley, it's sort of a lot of flat rounds, a lot of disguised flat rounds. Then you have a 2x liquidation preference, and if people are tough, maybe it's a 3x liquidation preference. So they're still good companies, but that's where the venture capitalists become vulture capitalists, take an extra pound of flesh. And that's where you sort of usually the founder's gone by that point in time. Then they have a management team in there, and the management team always gets re-upped. So they'll get an employee incentive plan of 15 or 20% with a carve out. So the venture capital last money in win. So if you have a living dead and the last money goes in, we'll definitely win and get a nice return. And it's good for the second generation management team. So those are the games that we're probably going to start seeing in the Canadian market over the next 12 to 18 months.
Thanks. Talking about La Caisse a little bit, like you talked about, well, obviously we know CDPQs everywhere in the ecosystem and all stages. And we saw a lot of complaints in the market against the other pension funds in Canada were much less invested in the tech ecosystem than you guys are. Do you see that moving forward, continuing to be the role that Caisse plays? And obviously there might be things you can't talk about.
No, within the CDPQ's mandate, we have a dual mandate to create economic development in Quebec and drive massive returns in Quebec. So if there's a Series C company that might be doing 8 to 10 million in recurring revenue, we'll be all over that. So I think it's a great opportunity for us to be the only pension fund in Canada that will actually write those big checks. So we can write that $50 million check or $150 million check. And the beauty of that is that if we write those checks, then you can go all the way to liquidity event or all the way to an IP. And so that's longer term patient capital, right?
But it's not easy for a public institution to cut those checks, right? In terms of what kind of talent and people you need. So how's that influencing the team you've built?
Well, one of the preconditions to working at CDPQ is I had two of them. Number one, I said I wanted to take French lessons twice a week, so I did that. And the second one was I needed to be able to close the deal within 6 weeks. And we did that as well.
Nice.
So we were able to close Lightspeed within 6 weeks. We were able to close Hopper in about 8 weeks. But we were actually faster than the Americans around the table because we led the round. We wrote the term sheet. Most of our due diligence was done prior to writing the term sheet because we already sat down with the company 3 or 4 times and we were able to close, right?
Yeah. Oh, nice. So could go on for a long time, but I would really love to open the floor to questions since we rarely have Tom.
So you seem to be describing a very interesting market dynamic right now going on in Canada with the opportunity for vultures and secondaries. Why haven't we seen any funds being created to do just that and do the cleaning of the ecosystem?
Northleaf in Toronto is funds of funds, and they have a big secondary business. In terms of other Canadian players in the ecosystem, True North in Waterloo has a small secondary fund player at this point in time. But I agree with you, it's a huge opportunity.
Yeah, foreign ones, right? Ardian is now in the market as well.
Yeah, good point. Good point.
Questions? Dave is or Porty's asking questions.
Do you think we're too polite to recap companies? So when you talk about these big valuations that happen, like everyone sits around tables and says, companies overvalued. I'm not a buyer of that. Rather than saying, screw it, I'm going to go and I'm going to be the big bad wolf and I'm going to recap this company and come down and bring back the valuation to a reasonable amount, push investors down to another class of shares and ride this upside, which is kind of what you were alluding to about funds go and fix a bunch of these companies and refund them. Do you think we're too polite to recap them? So I don't see a lot of funds necessarily doing that.
But you sort of have to live through a couple of cycles to have the conviction to actually recap a company. But the counterpoint is that a lot of the funds in the US are so massive that they'll continue to do flat rounds, right? They've already got 40, 50 million in. They can easily put another 10, wait for the company to grow back in its valuation, and then go for an up round thereafter. Whereas in Canada, we don't necessarily have as much American money up here. So in terms of doing a recap, it can be done, but it's not perceived to be a negative thing. It's not like it's a down round, but it shouldn't be come with all the extra hairs like with a 2x liquidation preference. You just say, okay, we think that company's worth 200 million, it's not 400 million, and you put in a clean term sheet, maybe a senior ranking pressure, and that's it. You don't have to have all the other hair around it.
Great question. Any other question? Yep.
Thank you. Aaron with Betakit. I was just wondering, so you touched on not having a lot of American money up here. How do we get more of that, both at the fund level and for entrepreneurs?
Number one, you always have to be marketing, right? So if you want to get an American VC up here, every time you're in California on a business trip, just go down and talk to the VC. Say, I'm here. This is what I do for a living. If you're interested, give me a call, right? And after you knock on the doors 4 or 5 times over a 2 or 3 year period, they're going to come up here. But it also takes Canadian VCs to invest in the United States. So if we invest in a Boston company, there'll be a Boston VC. Then the Boston VC will say, what else do you have in your portfolio? Then they'll come back and invest in the Canadian companies here. So it's a bi-directional path, because if we don't invest in the US, the Americans won't invest in us.
But that's a challenge too for, let's say, we have majority of funds here are emerging, like fund 1 to 3. They typically have 60 to +% of their capital coming from institutions that require the capital to be deployed in Quebec or in Canada. So how do you navigate this challenge, right?
Yeah. So in a more mature fund like Eunovia,
Of course, yeah.
they do deals in the US, and then it helps in the bi-directional activity. But for a first time fund, you have to say, okay, I need the right to invest minimum 20% in the US. And you got to stick with the hour plane trip rule, as in Boston and New York and nowhere else, because you have to be able to sit down and meet with the companies at least on a monthly basis, right?
For questions?
But I have a question for Jacques Perrault. What's the worst deal that you've ever done?
Well, hold on a second.
And was it with like us?
Yeah. I just want to comment on the fact that Canadian VC needs to invest in the States. I do agree in principle, and it's a great idea, but you need to have the resources and the time to do that, because when it was the case, we did that, but the way we did it, we invest in funds in Boston, and then we have access to the good deals. But if you're a small Canadian fund going to Boston or New York, those guys, I mean, they know each other. The good deals, they will share it between themselves. Why I will have access? How can I have access to
so
good
you
deals?
can get into the Boston club, but you can't get into the California club.
Yeah.
Right? So every time I see a deal coming out of California, it's been shopped around everyone else in the world. So if it comes to me, it's going to be a shitty deal. So I'll look at the deals in New York and Boston, but I'll never look at the deals in California.
But still, it will take time to do that, because those guys, they do deal between themselves anyways.
Yeah, you just have to have presence. Right?
But it's a good idea, but it needs time and resources. Even the K's or Homers, when they do it, if you ask the question to those guys, they will say, yes, I'm doing deals in California, but I still don't have access to the best deal yet.
Mm-hmm.
But could it be the other way around as well? Sometimes, like basically, if like we see, I know we are investing in a Canadian company alongside Axel or alongside another, that could also be the trigger to develop a relationship, and then them inviting you to their deals, right?
Yeah, of course. You're a two-time entrepreneur, right? And so what makes you think that you're going to be a good investor?
Scars. Lots of scars.
The best investors tend to be the operating types who've already built a company. They understand sales, marketing, distribution. They know that you can't hire 20 salespeople. You got to hire like 4 biz dev people. Once you figure out the recipe, then you can hire a sales team. So if you're looking at VCs, make sure that you're dealing with the operating type VC across the table from you, because they might give you lots of advice, but they don't really have any operational experience.
Maybe a last question to then I close this evening. Like, any advice to entrepreneurs who are going to be fundraising in 2025? Like, what's the number one thing they should think about?
What size company? It's Series A?
Yeah, early stage. Yeah. Seed,
Yeah,
series.
the most important thing that any VC looks for, any VC should be looking for is repeatability. Repeatability on the sales cycle, repeatability in the product management cycle, repeatability on the engineering side. And if you can demonstrate repeatability, then they'll have confidence in you because they know they can fund you and you can scale based on the repeatability. Right.
Great. Thanks very much.
Go ahead.
You're holding us.
Against drinks. We talked about
Right.
funding emerging entrepreneurs and seed stage, pre-seed stage. How do you think we're doing on emerging managers and funding the next generation of investors?
Emerging managers should have a partner that has worked in another venture capital fund, because that partner is like an insurance policy to prevent you from doing bad deals. So if you've done a bad deal, you'll never do that again. And most venture capitalists learn from their failures. They don't learn from the winners because they didn't do anything, because they just took off. And when you get a big donut on a deal and you go, I'll never do that again. And what did you do wrong? I misjudged the management team, or I misjudged the VP of sales, right? So
Thank you very much, Tom.
now there's
Yep,
one other thing I wanted to share with you. Your earlier question. People always talk about going public, right? So to go public, you got to build a company and manage a company as if you were a publicly traded company. So with monthly financials, quarterly financials, you always produce a pitch deck to your shareholders on a quarterly basis. Is really a key way to run your business. But what we learned in Canada, like we always thought it'd be good to go public on the TSX, you get your training wheels on, and then you go public on New York Stock Exchange or NASDAQ thereafter. But I realized that companies need to have a minimum market cap of $5 billion for the U.S. institutional investors to have any interest in you whatsoever. So to have a $5 billion valuation, you need to have a company doing 300 to 500 million in revenue. So for you to get to that size is going to always take 10 years. Like for every $1 billion exit I've been associated with, it's been, the average hold time is 13 years, by the way. And so you might think along the way on what you want as a founder. You say, well, maybe my first company, I want to sell it for a couple of $100 million, cash out a little bit. And my next company, I'm going to try to get it to a $5 billion valuation and 500 million in revenue. But when an investment banker says, we'll take you public and you're only doing 40 million in revenue, don't even have that conversation, because they're looking at making fees for themselves and not actually building value for the founders and the other shareholders.
Good advice.